Okay, so we figured out step one, which was, of course, the ACB. So this is now, of course, step two. And just like we did before, step two, basically, we have to figure out what is the taxable policy gain so we can figure out how much tax has to be paid. And that is the same as before, proceeds of disposition minus your ACB. Proceeds of disposition, an example, once again, $50,000. The ACB, of course, was a little bit less than we had with the non-participating. So the ACB was $14,000. So from the 50, we deduct the $14,000, and you have a interest policy gain of $36,000. Okay, and once again, you're in a marginal tax rate of 35%. So that's your MTR, 35% of $36,000. You have to send CRA a check for $12,600. In other words, that is the tax only on this particular scenario is $12,600, okay? And that essentially summarizes basically this whole section of calculation of the adjusted cost base. That's the very first thing that you have to do. And always remember that we're only referring to policies issued December 1st, 82 onwards. That's the only time this actually applies, okay? Policies issued prior to that this does not apply. Once we calculated what the ACB is, which is basically how much premium you gave me, and then deduct the NCPI and dividends if it's participating. Once we've established the ACB, then the next thing to do is step two, which is the difference between the proceeds of disposition, which in our example is $50,000, minus the ACB, which in this latest example is $14,000. So we've got $36,000 left. And then you multiply that by your marginal tax rate, and that gives you the amount of tax that you have to send to Ottawa when you do your T1 on all this. So that should give you a pretty good idea of how insurance policies basically are taxed. In the next session, we will be talking about loans and how this actually applies in loans as well. But we will talk that in a minute.